the BIS cannot risk exposing the massive ETF rehypothecation scam held on the books of these same too big to fail banks acting as authorized participants for these trusts. And if you remember that unallocated gold and silver is the on and off ramp for whether it's GLD, iShares, SLV, those particular, and I'm not saying all the ETFs are the same, but certainly those are. So what we're saying is the short-term volatility we are experiencing revolves around the BIS efforts to unwind as many ETF unallocated contracts they can possibly trick out. Now, look, these are large funds who never take delivery, but use these ETFs to track the gold and silver prices. Now, these funds are largely momentum driven and easy to trick out. And the age-old psychological operations, the PSYOPs operations, it employs everything from chart painting, which we just saw, chart painting bearish technicals, and then what you do is trick in momentum-driven technical sellers. These are not physical people. These are people trading a paper price for to benefit from an up or a down price. So, and then what do we see as this? They're tricking out, but we know from a wholesale market perspective, hey, but this is a strong physical market. So what are you doing? And then, as we evidenced last week, no coincidence, when JPMorgan was wheeled out into a downtrending market just at the right moment to counterintuitively talk down gold, while Goldman's Jeff Curry was wheeled out to actually talk down silver. These are not coincidence. This is part of a psychological operation to actually trick out paper guys, not the physical guys. We view it as opportunities. These footprints tell us, though, that these same banks are actually going one-to-one long against their client Muppets. And I'm not calling them Muppets. It was, if you remember, Goldman Sachs actually used that term about their clients being Muppets. And what are you doing? You're actually taking the opposite side of what they're being recommended to do. So really the motivation for these counterintuitive efforts is really 100% focused on trying to shake out as many ETF spec longs as possible. That is the only problem at this point, is to try and unwind these massive unallocated positions that have migrated into the ETFs. You can't have an ETF coming into June the 28th with basically rehypothecated gold. It just wouldn't be compliant. So really what we're saying is the efforts for these counterintuitive moves are 100% focused on really just trying to shake out as many ETF spec longs as possible. And we've seen that. So to a large extent, they've already succeeded, but they are pushing the envelope into very thin remaining speculative short cover, which we just discussed. So, and it's important to understand this because that is the picture. So to fulfill their objectives any further, what they'd have to do is run prices lower into a very strong physical market, which would then force futures into backwardation. And we discussed that in prior episodes, exactly how that works. And they push it into backwardation against spot. But what did that do? Triggering the catch-22 arbitrage trade, which is, again, something we explained in detail in prior episodes. Now, if you remember, this actually happened last Friday night. And in fact, when I say Friday night, I'm talking about midnight on Friday, just when the market's the thinnest. What happened there? We saw a massive down move. And what that did was activate this trade. And there is going to be a price to pay at delivery.